Hello and welcome back to our second lecture video dealing with long-lived assets. So in this video, we're going to go ahead and take a look at depreciation, and hopefully by the time we finish this video, you should be able to explain the characteristics of depreciation, as well as you should be able to implement or illustrate the three depreciation methods. And we're also going to talk about impairment loss. Okay, so what is depreciation? Well, depreciation basically is the systematic expense of an asset, okay? Pretty much every asset we have is going to be depreciated, with the exception of land. Land is never, ever, ever depreciated, okay? So what we need to do then is take an asset, specifically take that cost of that asset, and we need to allocate it to the periods in which that asset helps us generate revenue, okay? So when we look at depreciation, we need to make some assumptions or some guesses, right? And we'll go with assumptions. That's probably better than guesses. So we need to estimate how long do we think this asset is going to last us. It's going to last us 5 years, 8 years, 10 years, whatever. That's the asset's useful life, okay? This useful life is very different from the actual physical life of the asset. What in the world does that mean? Well, that means that let's say we buy an asset and we intend to use it for 5 years. And after that 5 years, we plan on replacing that piece of equipment, okay? We assume that 5 years from now, the current piece of equipment that we have is going to be outdated, right? In 5 years from now, there's going to be a more efficient machine to do the same thing that we have. So that's what we mean when we say the useful life. That useful life is 5 years. Will that machine work for more than 5 years? Of course it will. Hopefully, right? It should. So what we need to do as a company or as management, we need to first estimate the useful life of the asset, and we also need to estimate the asset's salvage value, okay? When we're talking about salvage value, this is the value of the asset that we believe it will be at the end of the useful life. So let me give you an example. We're going to buy a piece of equipment that's going to help us make plastic Christmas trees, you know, the ones that light up. People have them in their front yard, those hard plastic ones. So we're going to buy one of those machines, right? That it's basically blow molding, if you know anything about manufacturing. So we're going to buy one of these machines, and we say that, you know what, the useful life of this machine is 10 years, meaning we're going to use it for 10 years and that's it, okay? How much is this machine going to be valued at the end of those 10 years? Well, we can guesstimate. It's pretty much what we're doing. And we say that, you know what, at the end of 10 years, this machine is going to be worth, $5,000, okay? That means that we think that that's the market value for that asset. We think we're going to get $5,000 at the end of 10 years for this machine, okay? Now, very important that you recognize that depreciation has nothing to do with market value. Depreciation is nothing more than a value. It's nothing more than a value for accounting purposes, right? It allows us to systematically match the cost of that asset or the expense of that asset to the revenue that we generate. So depreciation really helps us with revenue recognition and the matching principle that we talked about towards the beginning of class, okay? Remember, depreciation, we're not trying to use it to say, okay, on our books, with depreciation, this machine is valued at Y. That Y does not equal our market value. Okay, market value is something totally and completely different. We're basically just using estimates to figure out what the value of this asset is so we can report it on our books. Okay, so how do we calculate depreciation? Well, we have three methods. The easiest method you're going to see is straight line. There's also double declining or declining balance, and there's also units of product. So let's look at the straight line method. Okay, notice the calculation. What we're trying to figure out here, what we're trying to do is to calculate annual depreciation. In order to do that using straight line, we have to take our acquisition cost, which we talked about in the last video. We know what the acquisition cost is, what that value that we associate with acquisition cost, the cost of the machine plus any cost incurred to get it delivered to us and to get that machine ready for use. So we start with the acquisition cost and we subtract out our salvage value. Again, that's an estimate, right? After we do that, we divide that number by our estimated useful life. Okay, so let's assume for a moment that we buy a piece of equipment, and at the end of the day, that equipment costs us $5,000. Okay, that includes taxes, shipping, or freight costs, getting it to us, and testing the machine, getting it ready to run. Okay. We also estimate that this machine is going to have 3 years of useful life, and then after that, we're going to get rid of it. We assume that at the end of those 3 years, we can resell that machine for $500 to somebody else. What's our annual depreciation? Super easy. We take our $5,000 of acquisition costs, and we subtract out our salvage value. $5,000 minus $500. Then we divide by our estimated useful life, which in this case is 3 years. We get a depreciation expense of $1,500 per year. How do I journal that? What's the journal entry I do? This should be a review, because this is the same journal entry that we did back in chapter 3, I believe, when we did our adjusting entries, right? Our adjustments. So we're going to debit depreciation expense for $1,500. We're going to credit accumulated depreciation for $1,500. And this is to record the depreciation expense for the year. Okay? Now, let's look at straight line, right? Notice what we have here. We have our balance each year. We have our annual depreciation expense each year. We have our accumulated depreciation for each year, and then we get the asset's book value. So look at the value at the end of year 1, right? Our book value, based on our books, we had a cost of $5,000. We subtract out our accumulated depreciation of $1,500. Our asset's book value is $3,500. What about for year 2? Well, at the end of year 2, it's $2,000. Well, think about that. We originally paid $5,000 for this machine. The annual depreciation expense this year is $1,500, but our total accumulated depreciation is $3,000. So over 2 years, we have $3,000 worth of depreciation. Our book value is $2,000. And then look at the book value, assets book value at the end of year 3, $500, right? That's our salvage value, we assume. Okay. Now, declining balance method, it's a little bit more involved, right? What the declining balance does, it is an accelerated depreciation method, right? It allows us to recoup our costs sooner, okay? Or more of our costs sooner, and I'll show you what I mean when we go through an example with that. But when we're talking about the accelerated depreciation method, we're still calculating depreciation expense, right? Just like we did in straight line. But straight line, we took a constant dollar amount, right? It was $1,500 each year. With accelerated depreciation or declining balance, we're using a constant percentage of the asset's beginning book value, okay? So what we're saying here is that this book value declines each year as accumulated depreciation increases, okay? So our annual depreciation expense is going to decline each year, We can get into, double declining method. We can get into 1.5 declining method. But let's just look at what we mean here. Okay, so let's look at an example of this, right? So let's assume the same scenario, right? $5,000 cost, 3-year useful life, $500 salvage value, but this time we're using double declining method, okay? So notice what we have here. We have our acquisition cost that we start off with. That never really changes, right? It's five grand. But look what we do here. We start with our beginning accumulated depreciation balance, which in year 1 is obviously going to be 0, right? Because we need to calculate depreciation, okay? So what we're going to do is we're going to take our beginning book value of $5,000 and we're going to multiply it by twice the straight line percentage, okay? So that's how we got the 66.67, okay? So we're going to multiply the 5,000 times the 66.67. We end up with an annual depreciation expense of $3,334, okay? Now, we're starting year 2. What's our beginning accumulated depreciation balance? It is $3,334. So what's our beginning book value of year 2? Well, that's easy. 5,000 minus the accumulated depreciation of $3,334, we get $1,666. That's our beginning book value of that year. We then again multiply that constant percentage of 66.67%. We get $1,111, right? That's the depreciation expense. Now let's look at year 3, okay? What's our accumulated depreciation at the beginning of year 3? $4,445. We see that the beginning book value of year 3, which is acquisition costs minus accumulated depreciation, $555. Again, we multiply that by the 66.67%. Okay. Notice we get $55 in depreciation. Now, because we set our salvage value to $500, we do not depreciate below the salvage value, okay? So we will stop taking depreciation once we meet that for $4,500. Okay, so how do I calculate the unit of product method? This one's actually pretty easy. The calculation is, let's put it that way. It's a lot like straight line, right? Basically what we're going to do here is we want to allocate the cost of that asset based on the asset's use, not on time, okay? So how do we allocate based on use? Well, we have an estimate of how much product we think we're going to get from this machine, okay? So to calculate depreciation per unit, we're going to take, again, the acquisition cost minus the salvage value, just like we did in straight line. But the difference, since we're using unit of production method, we're going to divide by the estimated units of production, okay? So our annual depreciation then is going to fluctuate based on units produced, okay? So the annual depreciation is going to be calculated based on how many units did we produce, right? Well, what if we don't have units? Well, we can use other drivers as well, so to speak, right? We can use miles for a vehicle. We can use maybe hours used. We could use, units produced from a machine. All 3 of those are acceptable to use as long as they apply to the situation, right? We're going to depreciate a car. Well, miles driven, that's probably a good indicator to match up the cost of that car with the revenue that car helped generated, okay? So here's an example, right? We get our depreciation per year. And in order to do that, the first thing we need to do is we need to figure out, okay, what's our depreciation base, right? What's our allocated cost? What's our salvage value of this machine? And how much do we think this machine is going to produce over its useful life. So let's say that we install a piece of equipment, right? And this equipment is expected to last 9,000 hours, okay? Acquisition cost still 5,000, salvage value still 500. What's the depreciation per hour? Well, it's 50 cents per hour, right? 4,500 divided by 9,000 gives us 50 cents per hour. Now, notice what we have here. We have our depreciation per unit, and then we have the annual hours that we actually used. So look how the depreciation works, right? In year one, we use it for 2,000 hours. We get 2,000 hours out of that machine. So we take 50 cents times the 2,000. Our annual depreciation in year one is $1,000. But look at year two. Year two, guess what? We use this machine more. We use it 4,000 hours in year two. So to calculate year two's depreciation, we take our depreciation per unit, 50 cents, and we multiply it by the annual hours used, which is 4,000. We get $2,000 of depreciation. Okay, we do the same thing all the way through, and the next thing we need to recognize here is that we are, notice, not using time, years. So we're actually depreciating this thing for 5 years, okay? Because we're basing it on 9,000 units, or 9,000 hours. Well, it takes us 5 years to get our 9,000 units, or 9,000 hours used, okay? Now, depreciation for income tax, totally different than what we just talked about, okay? So for book purposes, either of those three methods are acceptable to use. However, for taxes says nope. The IRS says nope, we're going to tell you what to use, okay? So the IRS uses what they call MACRS, right? Modified Accelerated Cost Recovery System. And what MACRS does is it tells us we tell it what kind of asset we have. It's a chart, really. We determine what type of asset we have, and that tells us what class it goes into. Is it a 5-year asset? Is it a 7-year asset? Is it a 15-year asset? And they have the percentages that we need to calculate each year that we have that asset. Okay? Now let's talk about loss impairment, right? What is loss impairment? Well, let's say that we have a plant or a piece of equipment or any long-lived asset, right? And let's say our plant asset that we have falls, or the value of that plant asset falls, okay? And it falls an awful lot. That the future cash flow that we're getting from this asset are less than its book value, okay? So we say that the asset is deemed to be impaired, and we can record an impairment loss. Now, as I just say that, I'm thinking in my head, I realize that's probably as clear as mud. So let me give you an example. We buy a plant asset, okay? And that asset has, we'll use the same asset, $5,000. We buy that asset to help us generate revenue. Well, we estimate what those future cost flows are, right? We say that, you know what, I'm going to shell out $5,000, but in the future, year 1, year 2, year 3, this asset is going to make X amount of units. I'm going to sell them for X amount of price. I'm going to take out subtract out my expenses, my net income, right? I'm going to basically calculate my net income based on that future asset. And then I'm going to look at it and say, okay, did the value of this asset fall so low that those estimated cash flows that I estimated have coming in are lower than the book value of that asset? We say it's impaired, okay? So let's assume that equipment with a cost of $100,000 and accumulated depreciation of $6,000, right? So that means how much is it on our books for? It's $40,000, okay? It's estimated that the current fair value of this piece of equipment is only $10,000. We have an impairment loss, okay? How do we know that? Well, We know that because they told us, number one. But what's going on here that we aren't seeing? Well, we have $40,000, okay? It's on our books for $40,000. That future cash flow that we anticipate from this machine has to be less than $40,000, okay? It is. So we say, okay, what's the current fair value of this piece of equipment? It's $10,000. We're, instead of carrying that asset on our books for $40,000, we're going to carry it on our books for the $10,000. So we need an adjusting entry. So we have what we call an impairment loss of $30,000. We're going to debit impairment loss. We're going to credit accumulated depreciation, and we're going to record the impairment loss on that piece of equipment. Okay? So when we come back in our next video, we're going to talk about revenue expenditures versus capital expenditures, and we're going to talk about what's the difference between these two and what exactly do these look like. So tune back in for that video. But let's not forget the important things that we covered in this video. We saw how to calculate depreciation, right? And we saw each of the three methods: the straight line, the declining balance, and the units of production. Both of those are acceptable to use, or all three rather, excuse me. For taxes, depreciation's totally different. The IRS tells us what to do, or let me rephrase that. The IRS tells us how much we can take based on MACRS, which is that Modified Accelerated Cost Recovery System. Okay? We talked about impairment loss. Remember, impairment loss takes the current value of a machine, and we say, okay, here's what we have it on our books for. Here's the cash flow that we estimate from this asset, from using this asset and generating future cash flows, right? Those future cash flows are less than what we have it on our books for. We're going to do an impairment. We're going to do an adjusting entry for impairment loss, and we're basically going to mark it to its current fair value, meaning that asset's current fair value. Okay? So when we come back, we'll talk about the difference between revenue expenditures and capital expenditures.